So how will inflation impact stocks? You can't turn on the TV or open a newspaper without hearing about rising inflation. The inflation rate in the UK doubled in April and kept growing through May. In the US, the annual inflation rate is up to 5%. For investors, the big question is, how will this affect the stock market and where are the opportunities to benefit? What does inflation mean, therefore, for the stock market? During the last decade, the stock market has performed better during low inflation times. So if prices rise, what will that actually mean for your pension, your portfolio as a whole? Well, some sectors can be expected to struggle. For example, high inflation often leads to a rise in interest rates. If interest rates go up, many tech companies' rapid growth assumptions become less attractive to investors. When interest rate worries were high around April or March, we witnessed each of the tech stocks take a slight correction. Many experts are worried that fresh inflation concerns could see an interest rate adjustment, bringing trouble, of course, for tech stocks. Which sectors struggle during inflation then? Well, in a recent investor note, Goldman Sachs looked at market data over the last 50 years. They suggest that specific sectors struggle in times of high inflation. According to Goldman's research, real estate, healthcare, consumer staples, and the energy sector are all strong inflationary market performers. However, they caution that past performance suggests that the materials and technology sectors could be set to struggle. Of course, it's not just Goldman Sachs that are issuing warnings. Chief Investment Officer at HSBC, William Sells, made some interesting points about the market lately. He cited low inventories, supply chain issues, which we're all well aware of, and wage pressure in the hospitality and retail sectors as significant factors causing inflation. However, he suggests that this inflation is temporary. Additionally, Sells indicates that the Fed and the US policymakers agree with him and won't intervene too quickly. His two tips are to invest in the financial sector and reduce your portfolio's exposure, again, to tech stocks. Well, will monetary policy change to stem inflation? In the UK, the Bank of England is definitely under pressure. And looking at traders and the balance of trades that they're placing, it does look like they're factoring in rising interest rates very soon. The Bank of England's failure to forecast growth and price rebounds have left many economists wondering how they will manage inflation. Of course, this news comes after the Fed suggested they will start raising interest rates in 2023. After a two-day meeting, the Fed has said its view on the economic situation and will keep monitoring it and will likely implement 2 interest rate jumps in 2023. But for now, the rates will stay around 0.25% levels they have maintained during the pandemic. Again, this might signify poor news for tech stocks in the long term. So, where and which stocks are the best way to beat inflation? Though many experts suggest high inflation will not last, investors need to have a plan in case it does. Analysts at Citigroup have indicated that investors may find the best way to beat inflation in this market is actually outside the US. In a research note from June, Citi analysts looked at the cyclically adjusted price to earnings ratio, or CAPE, across global markets. The US markets showed a high rating of 39 times CAPE, and that's led Citi to suggest it will have a 6% return for the rest of the decade. Pretty poor. However, the inflation being at 5% currently in the US means Citi says investors should look towards other markets. If you're only getting a 6% return and 5% inflation, your real return, of course, is therefore 1%. Citi believes that 4 other stock markets will provide double-digit returns: the UK, Germany, France, and Japan. So, will inflation cause a market crash? Well, a decade of cheap money and low interest rates have fueled a massive bull market. However, rising inflation could hit both of these because that's what tends to happen. History suggests so. Again, the Federal Reserve and the Bank of England's actions are important here. If they feel the economy is overheating, they may well pull back the stimulus and make it more costly to borrow. This scenario could hit the market heavily. However, it's just of many possible outcomes. My conclusion? Well, while inflation rates in the UK and the US are higher than most economists would like, their cause is unclear. Several factors seem to be influencing the rise of prices, including the economic rebound. Indeed, supply chains and even labor market shortages are also a factor. For investors, worries about inflation causing a stock market crash are overblown. Indeed, adjustments to monetary policy will be used to manage an overheating economy. Short term, as prices continue to rise, real estate, energy, and health sectors look attractive. Similarly, any portfolio with excessive exposure to tech stocks could probably do with a bit of exposure to other sectors outside of that. Having said all of that, I think there'll continue to be a flight to safety to some of the big, most successful, safer tech companies, safer by volatility and safer by the cash pile they have and the cash flow they generate. For me, those continue to be Apple, Amazon, Alphabet, Microsoft, and Facebook. Yes, there are others like Adobe and Oracle, but those five, despite rising inflation, will still remain the core of my tech strategy. Thank you. I hope you've enjoyed this. It's part of my campaignforamillion.com, to help explain finance to a broader audience and teach 1 million people how to be better investors. Have a look at the website for free education, downloads of my book, and lots of other resources on there, all free. That's campaignforamillion.com. Thank you. Oh, and by the way, the research centering around this article, that'll be around this video. There'll be a link to the research that I've used to make this recording. Thank you.